Markets with David Modell.
Welcome to Looking at the Markets with David Modell. Today my guest is Mr. Vance Harwood. Mr. Harwood is a private investor and consultant focused on volatility as an asset class. His areas of expertise include volatility, VIX, VIX futures, volatility ETPs, options, backtesting, Monte Carlo simulations, and much more. Mr. Harwood is the president at sixfigureinvesting.com. The link to that is in the description below this video. You want to click on it for sure as soon as you're done watching the video. Also, you can find Mr. Harwood on Twitter. His handle there is at @6_figure_invest, and that link is also in the description below this video. All right, after all that, Vance Harwood, welcome to Looking at the Markets, sir.
I'm glad to be here.
Yeah, glad to have you. Been looking forward to this. I am stealing David Lincoln's guests one by one. So yes, guilty as charged. And shout out to Mr. David Lincoln. Check out his channel as well. All right. So want to start with I guess you could call it the 800-pound gorilla in the room. Monday, February 5th was known as Volpocalypse. Ooh, maybe they'll make a movie out of it someday. Who knows? On that particular day, on February 5th, the S&P 500 went down a little bit over 4%, something we haven't seen in a little while. And then maybe people thought, oh, it's finally over. And then on Thursday, February 8th, the S&P 500 went down 3.5%, almost as much. Ooh, okay, so... After all that, I'm trying to find ways to relatively safely, or at least in a risk-defined manner, short vol products like UVXY, VXX, things like that, TVIX. I'm never going to go naked or uncovered with my shorting ever again after that. What are some risk-defined ways or relatively safe ways to short vol products that you prefer?
Okay, so I think there are a couple factors there. One is you need to recognize that if you look at historically, the VIX futures are going to be in contango approximately 85% of the time. So those are the sorts of times when the short vol trade treats you well.
Yeah.
15% of the time you have the situations where things are in backwardation, the market is very chaotic, and you definitely do not want to be in short vol. So that's kind of the background to that, and that's part of the attraction of the inverse vol investing is that if you're looking at the S&P, the odds are more like 50-50. The last year is kind of unusual, but in general, and if you look at the statistics, it's about a 50-50 call as to whether they'll be up or down on any given day. So when the VIX futures are in contango, that shifts in the favor of the inverse funds in the shade of like 85%. So there's a lot of attraction there, but the dark side of that is that 15% can sneak up on you very rapidly.
Yeah, for sure. And we found that out during that whole Volpocalypse event or multiple events. And so I've made a little list of some risk-defined ways to short vol, because again, I'm never going uncovered with it again. Just selling uncovered calls or just shorting shares. That's not for me.
Right.
I found out how vicious those spikes can be in volatility. Luckily, I was all in cash at the time. Thank goodness. All right. So I survived, but not everybody did. Okay. So this is my short list of ways to relatively safely short UVXY, VXX, and so on. Selling call spreads. Okay. Make it a spread by also buying some calls. Buying put spreads. Shorting shares. Yes, but also buying some protective calls. And then finally, shorting shares, but also buying some offsetting type of shares. Those offsetting shares don't have to be vol products necessarily, but something that would go in the opposite direction. So out of those choices, or maybe some option that I didn't think of, what is your preferred method of risk-defined short vol product trading?
Okay, well, some of it depends on your risk tolerance. So that's So I would say my preferred approach is just buying puts, protective puts. So if you're long SVXY, then buying some protective puts. They're not cheap,
Yeah.
but this is where the situation where SVXY not going below zero guaranteed by the prospectus actually helps you, because the option maker, the market makers have a predefined maximum loss, and that actually makes those cheaper than buying, say, VXX calls, because in the case like that, there's really no, VXX can go up more than 100%.
Yeah.
So while expensive, if they're out of the, and these aren't right at the money, obviously, but these are ideal when you have a bit of a profit, or roll them up as you have a profit to give yourself more protection. So you might set up and say, well, I'm willing to take a 20% drawdown, set your puts there, and then if that position does well, then you can roll those puts to higher and higher strikes to lock in some of your profits.
Interesting. Okay. Would you be amenable to, let's say, helping to pay for those protective puts by using a collar type of strategy, meaning also sell some covered calls?
Right. Yeah, you can certainly do that, because you limit your upside. And it's always funny when you go to look at things like that. You never feel great about it. The calls are always too cheap, and you say, "Oh, I'm giving up all sorts of upside," and why? Ultimately, if you try to hedge yourself perfectly, you usually make no money. So you really got to decide where you're going to take your risks.
Sure. Okay. It sounds
and it's tempting on this for people to do put spreads, for example, and I look at that.
Okay.
But that the fifth played that out exactly, in the sense of, if things do collapse, you're going to hate yourself for having a short put, even if it's 50% out of the money. That it does not protect you against the sort of things that can happen.
Yeah. Very true. So it sounds like you believe, or may believe, that there is a future for SVXY, that because a lot of people are very hesitant after seeing what happened to XIV, although the prospectuses are different. Is that the main reason you see a future of upside for SVXY?
Well, I think there's still the attraction of short vol, and I think a lot of the professionals that I work with were all out of the position. So in terms of all spikes, this one was a very predictable one. That might not feel the way to most people, but the indicators that the people that are really in the people I work with, we've certainly, there's some indicators, and the market was, the VIX was up a lot. The ratio of the 30-day versus 93-day VIX was in kind of danger territory. So, I think the people that are familiar with this are saying, well, the trade's still there. It's probably still going to be good 85% of the time.
Yeah.
And so has not scared away that portion of the investors.
Okay. So we don't have to, I don't need to be scared away from the short vol trade. I just need to do it differently.
Well, I think it is a scary trade. I wrote a post recently called A Better Model for the VIX. And basically, normally what you hear is a simple mean reversion sort of a strategy that says, well, the historic mean of the VIX is around 19, so there's always this huge pressure to go up to 19, but it's hardly ever there. Well, I really looked at that in detail and to say, no, it's really a better model to say that the VIX wants to be more around 12. And what happens is that you have these random spikes that come along that spike it up, and then it kind of slowly relaxes from that. So the aspect of that is the spikes really are random, so they're not predictable. And at a very low VIX, you can say there's an increased risk because the vol has a tendency to have even more beta at that point. So it's a scary trade. So I think you need to be talking about protection and diversification.
Yeah.
And that was the other thing I wanted to mention. A company I'm involved with, Invest in Vol, the strategy that we use is we have 3 different strategies, and looking at their historical record, they're not all that correlated. So all of them have these big drawdowns. They weren't as bad as this particular drawdown, but they didn't happen at the same time. So you basically get the situation where the odds of all 3 of them being in the market at the same time is much lower than if you're just doing a single strategy.
Yeah, that makes sense. Invest in Vol. How can people contact Invest in Vol?
Just their website is investinvol.com.
Okay, I'm going to put that in the description as well. Investinvol.com. Got it. I know you from Six Figure Investing, but I'm going to check that out as well as your Twitter, which I recommend people check out. A lot of resources. Fantastic. Wanted to ask about, there's a robust debate going on StockTwits, Twitter, etc., about is it sensible to short vol products during backwardation? Some people say, well, okay, backwardation is going to be a tailwind for vol products, so you don't necessarily want to short them
for long vol.
Right. For long vol products, right. For UVXY, VXX. So you don't want to short it during backwardation. On the other hand, I've heard it said that, hey, during backwardation, that's when the VIX is way up, and that's when you want to short it. So what is your perspective on that?
Well, I think I view this as kind of the day trader versus the longer, the swing trader sort of discussion. So if you have a really good sense for the market and if anybody's going to be successful, for example, at trading UVXY, it has to be someone that's going long UVXY. They have to be someone that has a really good sense of market flow and I think talent in order to pick the ups and downs on that. So right now there's the potential for big gains and big losses because you're getting very violent moves. But we are in that 15%, the chaotic thing, and when volatility is high, it's not just down volatility, it's also up volatility. So those things are pretty symmetrical. So it's a high risk trade. If you're a talented day trader, you can make a lot of money because there's big moves. But if you're not, you can get your head handed to you pretty quickly.
Okay. So, but as far as for the short vol trade, if there is backwardation going on in the VIX futures term structure, do you recommend, again, some people say, well, when it's in backwardation, that's the perfect time to short vol. Other people say, no, let me just stay out of it. What would be your inclination?
Well, yeah, my experience, that's equivalent to the long vol, is that you're basically doing day trading. It's very high risk. If you have a talent there, you can make money.
Okay.
It's the difference in terms of the VIX futures is that right now, when things are really volatile, you can see the entire curve shifting up and down kind of in unison. And those are big moves. You can get, 20% moves. Whereas when you're in the 85% of the time, you're in contango, the curve typically doesn't shift that much, but you have a tailwind for inverse because these futures are declining toward spot. So that provides the asymmetry in that trade. And there you're much more comfortable holding on and not watching your screen every minute because otherwise you can get clobbered.
Got it. So what I'm getting from this is that attempting to short vol products during heavy backwardation, like we saw recently, is only for the most nimble, the most expert, and people perhaps with shorter time frames and and plenty of time to watch the screen. Is that would that be accurate?
Absolutely. Yeah, I put talent in that category because I think there really is the day trader. There's a talent aspect that I think it's not enough to just be knowledgeable. I think you need some talent also.
Yep. And I never assume that I'm smart. And so, you know what, I've decided to sit it out during the period of backwardation, which, because I never assume that I'm smarter. I'm going to outsmart the market. So that's just me.
Yeah.
Want to talk about sixfigureinvesting.com. I love the blog. What are some of the products? I saw some spreadsheets on there. What are some of the products available on sixfigureinvesting.com?
Right. So my specialty is on volatility. I've been interested in the VIX since 2006, and I'm an electrical engineer by background, so I really like to dig in to understand these things. So I had a project where I basically said, all right, I want to start with the true underlying, the VIX futures, and from that I want to build up how these exchange traded price products, where their prices end up, and how those indexes move. So it turns out that that's not a trivial project. So basically, the future's been trading since 2004. So the advantage of that is that, once you figure out the algorithms, which I did from the prospectus, then I can just run that backwards in time. And so even though the ETPs were not trading until the first one was 2009, I can run that back to 2004. So that's what those spreadsheets are mostly, is the VIX futures back to that point and how the indexes are computed. And then I've also some of the other volatility funds like the velocity shares, SPXH and XIVH. Some of those other products I've also done back tests on those. So you can run your test strategies against that and see how they would have performed, let's say through 2008, 2009.
Those sound like great products. They're spreadsheets. They're all available on sixfigureinvesting.com, along with the free resources on there and the blog, which is a must-read. So below this YouTube video, go ahead and click on it. Check it out, by all means. Also, don't forget to go on Twitter, and please follow Mr. Vance Harwood. It is at 6_figure_invest. You don't have to remember all that. Just click on the link below. You'll get there. All right. As well as investinvol.com. What different products are on investinvol.com that are not on sixfigureinvesting.com?
So basically what that firm offers is kind of the headline product is, as I mentioned, the combination of three strategies. So that's a registered investment advisory firm. So essentially, if you invest with them, you'll set up a brokerage account, and then that account is automatically traded according to the strategies that are offered with that particular product. Now, you can't select one of the individual products, but I think that people they see the value of having the three strategies. So I think that's
that makes sense. Absolutely. So now that SVXY is priced at a massive discount, I mean, it was well over 100 for a while there, and now it's in the teens. Why not just hodl it, as they say? Why not just buy and hold that?
Well, some of the people that I feel the worst about are the ones that felt that these were buy and hold funds, because you look at the long-term track record and you say, well, it's done really well since 2004 in my simulation, so why not just buy and hodl it? But these drawdowns are vicious. This was a record one for SVXY. It was 90%. For XIV, it was 96%, which tracks the index. That's what the index does. But there were 60% declines before. So, I think it's just very difficult. You're dealing with compounding. So when you drop 90%. It takes you a lot more than a minus 90% to get back up to where you were. So I just think it's too risky.
Yeah, that makes sense. And this was just a regular, healthy, normal, quote unquote, 10% correction in the S&Ps. This was not 2008 or even 2011. And it wiped out a fund, XIV, and it nearly wiped out SVXY. So those spikes are pretty vicious and could get a lot worse. Now, I understand that you're not a huge fan of buy and hold strategies in general. Why is that?
Well, I think the frustration I have, and this has kind of sparked my interest in the VIX, is that diversification works really well until you need it. So the idea of diversification is if you have truly non-correlated assets that move in opposite directions, and historically bonds have been that they pretty reliably moved in the opposite direction of stocks. Holding stocks and bonds makes sense because they tend to offset each other. What we're seeing over time, and I think this is somewhat a technology thing, is that the assets are becoming more correlated. So that normally they might move in opposite direction, but when things panic, they tend to all synchronize and go down together. So, the S&P, even though it had 500 stocks, went down over 50% in the 2008-2009 timeframe. So, the VIX at a surface level is perfect because it's pretty reliably goes in the opposite direction of the equities. But unfortunately, carrying the VIX in any sort of way is very expensive. Being long UVXY or long VXX or long put options, all those things are very expensive. So it's really not. No one has really come up with a great way to use VIX to diversify.
Yeah.
At this point.
Yeah. Who or what entity is buying mostly these long vol products? UVXY, VXX, TVIX, VIXY. Is it retail traders who are speculating? Is it hedge funds hedging? Who's buying all this stuff?
Yeah. No, that's a great question. Is that I think UVXY, the trend I see is just a lot of day traders. You know, that there's two camps. There's the day traders, and then there's always a group that's convinced that the next vol spike is just around the corner. So they feel vindicated at this point, but even then, you know, holding these for more than a couple weeks might be painful. So I think some people are just saying, well, you know, the VIX has been abnormally low. Mean reversion is going to force it back to 19. I buy a bunch of UVXY or VXY long options, and I'm going to be rich. Well. So, you know, a couple times a year I get an email for someone that says, you know, I'm down, you know, $300,000 with my UVXY position. What are my chance of recovering that? Let's say if we have, you know, a bear market. And the bottom line is there is so much decay on these things that even if you hit it perfectly, you're still not going to get back to break even if you hold these things for very long.
Some people might say, well, I'm super clever. Tell you what, Vance, I'm just going to work with the VIX futures directly. Okay, I'm not going to go through the vol products, VXY, TVIX, VXX. Is that a way around? Is that a legitimate way around that problem?
No, that's a really good question. Is that I think that there's, in my opinion, there's nothing structural about the problems with the ETPs that isn't also in the futures. So the problem you have with the futures is they expire, so you got to be thinking about rolling them all the time. Then the question is, when do you roll them? So do you wait till expiration? You know, and the other thing is they have variable leverage. So the front month future, let's say it's 30 days out, it moves at about half of the percentage moves of the VIX. So if the VIX moves up 10%, it'll move up like 5%. But the closer you get to expiration, that beta picks up. So like the day before expiration, that's moving like 80% of the VIX. So your exposure gets much higher. You know, without you doing anything, your exposure gets higher as that approaches expiration.
Okay.
And then you still suffer from contango because normally that long future is going to be dropping down in value, then want to roll into the second month future, which is also rolling down towards spot. So you know, you don't really dodge any of the fundamental problems going with the futures as opposed to the ETPs.
Right. It sounds like this is the impression I'm getting from speaking with you and other experts in the field is that there's really no good way over the long term to go long volatility. Would that be accurate?
That's a very tough trade. Yeah, I think Artemis and that camp. Are you familiar with Chris Cole and that group? Or okay. Yeah. So what they do is they use hybrid strategies where essentially they if there's big moves, they're long vol and would make a lot of money, and then they're doing some low vol, they typically doing some short vol with kind of contained risk to offset their losses because they're getting killed on their long position, so they need something to offset that.
Sure. That's one approach. If it works for them, great.
Right.
You know, I wonder how that 50 cent, mysterious 50 cent person who keeps making multi-million-dollar long vol bets is doing. Maybe he's made all his money back in the last 2 weeks. I don't know. But
actually, I put out retweeted something on that. They went from like minus $200 million to plus $200 million, so it paid off. But they were down $200 million at one point. So
and that's a pullback that most people couldn't stomach in their portfolios.
Right, so, exactly.
Yeah, it looks easy on paper, but not so easy for most people. A couple more questions, if I may. I mean, this is fascinating.
Sure.
Why do you prefer ETF investing over individual stock investing?
Mm-hmm. Well, I think it really comes down for me for diversification. Earlier in my investing career, I did a lot of stuff with stock. And one of my frustrations was you could have stuff that came out of the blue that just really clobbered a stock. You could have a lawsuit, or the COO leaves, or patent, and so the nice thing about the S&P 500 is it's diversified enough is that you don't have that kind of randomness. It's hard enough without having that kind of randomness to deal with. So I think that's that being said, I think I have some friends that have done very well with individual stocks that they tend to pick, the Amazons, the Apples, those sorts of things. But you need to recognize those do carry embedded risks, and they can move. If things go badly, they can take big moves. You don't get a 40% move in the S&P 500, whereas you could get a 40% move if Apple had super bad news, or even more so in Amazon or something that has no actual PE ratio to speak of. So those stocks or Tesla are very vulnerable to those sorts of problems.
Right. With, let's say, SPY, the State Street Spiders, for example,
right.
No worries about, there are no earnings reports for the S&P 500,
right.
no CEO to say something stupid and ruin everything.
Exactly.
Yeah. So those are great points. And then finally, Russell Rhodes once said, know what VIX can do. Mm-hmm. And he's referring to, how vicious these spikes can get.
Right.
So what is your take on what VIX can do? I mean, what we saw in the vol apocalypse recently, was that just a little taste? How bad could it get for people who short UVXY, TVIX, VXX without some sort of hedge? How bad could it get?
All right. It's a great question. So I think I haven't gone back and reviewed it. At 3:30 on Monday Eastern time, I looked at the market, and the VIX was in record territory. It was up plus 75%. I'll have to review. That's a multiplier of about 25 over what the S&P. And I wasn't shocked. It was kind of like, okay, this is not unprecedented. What played out in the next hour was unprecedented, and that was the move of the VIX futures, which at 3:30 Eastern time was running about 30% of that move. So I don't know what that was. They were up, 35%, kind of in that range. Yeah. And what transpired in that was unprecedented. Previously, the record in the flash crash in 2010 was the futures moved about 65% of the VIX. Well, what we saw on the 5th was the VIX futures in that last hour, they moved from being 30% of the VIX move to 100% of the VIX move. So there was this huge ramp up in the VIX futures. And, my analysis on that is it was a liquidity issue where you had like over $1 billion of VIX futures that needed to be bought at the close of the market. And there just weren't the sellers out there. Yeah. So when you get that kind of imbalance, then there's really not much to constrain that. So I think the bottom line is, the VIX is still young. It's 30 years old. We don't have that much data on it, and we just saw a data point of, and it could be more than 100%. There's nothing that constrains the futures. I don't know how much you've been following this VIX manipulation claims and those sorts of articles, but anybody that follows this at all knows that the VIX and the VIX futures are different beasts, and sometimes go in opposite directions. So they're not like they're locked together.
Yeah. I've seen that debate about VIX manipulation. I don't know if I believe all that. That sounds kind of conspiracy theory-ish. There might be something to it. I'm not smart enough to know, but it seems to me that what happened is what ought to happen when the VIX is at 9-ish for a year. Because as you've mentioned, that makes it that much more sensitive to an unexpected, and they always are unexpected, vol spike.
Right.
Does that make sense?
Yes, absolutely.
Okay. Yeah. So I'm not alone in thinking that. Okay.
Yeah, right. And I've actually, I have a spreadsheet that computes the VIX from the SPX option. So, and also I've studied the what they call the Haas, or the special opening quotation that happens every month when they settle the futures. And historically, I think it was manipulated. I think in the early days, there were people that were going in there with bids and influencing the expiration. But the CBOE has continuously improved the process. So I really think that at this point, that it's pretty robust.
Yeah.
And the academic study they reference, I'd have to review it, but my first impression was they didn't take into account that the CBOE was improving their process over time. So they took the whole time span, and I think they really should have looked at a nearer term to see if that effect was still there.
Got it. Well, I've really enjoyed this. I've learned a lot. I've been reading Six Figure Investing, been watching your tweets. Again, people need to check out sixfigureinvesting.com. Check out those products that are offered. Well worth the investment. Investinvol.com. Check that out, as well as 6_figure_invest. That's the handle on Twitter. Mr. Vance Harwood, thank you so much for doing this.
Good.
And you're welcome back anytime, sir, on Looking at the Markets.
Do we have a couple more minutes, or?
If there's more you want to say,
right.
Go for it.
Yeah. Something that I just wanted to mention for people that are thinking about investing in vol products is, usually you have to sign a waiver with your broker in order to invest in it.
Yep.
But I've been thinking we almost need to have almost a driver's license sort of a test, because my interactions the last couple of weeks, there's a couple fundamental things that people are not aware of that they really need to. So number one on that is, the ETPs and the VIX futures are two separate markets. They're not hard linked. There's arbitrage that goes between them, but it's not reliable. So it's not reliable, and especially when things are bad. So there's something called the IV price, the indicative value, and this is a quote. Let's say you're investing in SVXY. So there's kind of the trading price that you look on the ticker that it's trading at a certain value. Let's say 20. All right, well, there's also an SVXY.IV, or it varies depending on your broker, and that's the theoretical price based on the futures itself. So those are two different prices. Normally, those will be within 1% of each other, but if the market is stressed or chaotic, those can diverge dramatically. And this is true of any exchange-traded product. So before you trade in these things, you need to find where the indicative value is. Have that on your watch list so you're watching that. And before you do anything, you need to look at that and say, if those things are diverging, those two markets are not being coupled together the way that they normally are, and you need to be very careful.
Yeah. Okay.
So that's one thing on the driver's license. The other one is the ETPs, the volatile ETPs, they don't close at 4 p.m. Right. They close 4:15 or later, and that's triggered by the VIX futures settlement. Yeah. So there's no end of confusion. People are looking at their screens and saying UVXY is up 10% and the XIV is down 12%. They're not the opposites like you would expect. But if you look at the IV quotes, they're usually very, very close. So there's all sorts of confusion about that. So it's not after hours on those ETPs until after 4:15, and that settlement price is what they reset to. So the rebalancing that caused all this problems on Monday, that 4:15 print was the crescendo of all the buying.
Yeah.
And that ended up setting the final prices and those sorts of things.
Okay. And that's what happened with XIV on that particular day, which was the end of XIV as we know it, or will happen very soon. Got it.
Right, exactly. So I just really encourage people, and the prospectus has a lot of stuff. If you're putting significant money into these products, you should read the prospectus. Yes. I know that's a pain and they're almost unreadable. Start with my how does XIV work or how does UVXY work. I have posts that kind of get you from the tutorial up to kind of the intermediate level. But if you're investing serious money on these, you need to take a look at it.
Yeah. Go to the blog on sixfigureinvesting.com. go. There's an archive of the blog entries there, and some of those, actually all of those are required reading. But some of those are, like you said, maybe they should require a driver's license type of test to invest in these products, because they're dangerous if used incorrectly. Can also be very profitable if done in the right way, which is what you're all about and what I'm trying to aspire to. So wow, did I miss anything else? I'm learning a lot here.
No, I think that's. I just wanted to emphasize that because I was just really shocked that people were not more tuned into this. And certainly, if the market is well, I think the other thing is just this is kind of in the rookie category, but the term structure, the VIX term structure is in backwardation. If you see the short month futures being more expensive or even close to the other ones, that's danger. That's red light. So unless you're really confident, it's time to, you've probably gotten stung a little bit at that point, but your risk tomorrow or even the rest of the day is much, much higher when you see the term structure doing that.
And that's why I'm staying out of the trade right now. For me, cash is king right now. And until I see that term structure go up from left to the left side of the screen to the right side of the screen, I'm just going to sit it out because, again, I don't assume that I'm smart at anything.
Yeah.
I think that's the best attitude for me. All right. So Mr. Vance Harwood has been my guest. I've learned so much today, as I always do from you, sir. So if you ever want to come back on Looking at the Markets anytime, just to review or just to let us know what's going on with six-figure investing and investingvol.com. You're welcome to come back anytime, sir. Thank you so much, Vance Harwood.
Sounds great.
I appreciate it today.
You bet.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.